about yield to maturity and how is yield relevant and related to the yield to maturity. So first of all, let's use a simple example. If you stick in some amount of money now, you're going to get some future amount of money, and you're going to have that at some interest rate. And to keep it simple, let's assume it's just a time period of 1. In this case, your yield is going to be your interest rate, and that is also going to equal to your yield to maturity. That shouldn't be too bad. It gets a little bit better understanding if you think about more than one time period. So what if we have 2 time periods? We have a time period of 0, 1, and 2. And we have our interest rates. We have interest rate 1, and we have interest rate 2. Now this is going to be yield for the first year. This is going to be yield for the second year. But the yield to maturity is going to be neither of those. It's going to be your combined amount. And that's going to be your yield to maturity. So how do we calculate that? Well, let's stick in some numbers and it'll all make sense. Equal to 12%. So if we have our amount, let's say we had $1,000 in the beginning. We put in $1,000 to this investment, whatever it is. And for the first year, we're going to make 10%. And for the second year, we're going to make 12%. You'll find you'll get some number 1232. And that's going to be the amount of money that you're going to get out at the end of the day. And so now we just want to find an interest rate that'll give us this amount over 2 years. So it's going to be some number that's kind of like the average of these two numbers. So let's calculate that. So 1232 divided by 1,000. Then you need to account for the number of time periods. In this case, we only have 2 time periods. And if we minus 1, you're going to get your interest rate. So let's see what that is. 1232 divided by 1,000. Power of 1 divided by 2 minus 1. You're going to get about 11%. Approximately that. So now just to verify what that means, and that means if we stick in this amount of money, $1,000, and we times that by 1 plus our interest rate, we should equal our amount of money that we get out of it. So just to verify that, $1,000 times 1 plus that amount over 2 years, remember, not just 1 year, 2 years, because this is 2 periods. You're going to get 1232. And this number here, therefore, is our yield to maturity. It's a number that if we stick in $1,000 at this interest rate for this entire duration of time, we'll get this amount of money. So that's what the yield maturity is, and the relation to yield. Yield is just a interest rate over a single period, and yield to maturity is just the interest rate over the entire duration of however many time periods you have. It could go on and on and on. And you just have to remember that the interest rate is going to be the amount that you can put in for $1,000 to get whatever number you have at the end, and it'll give you this amount overall. So hopefully that was helpful, and we'll see you next time.